My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So this is the 4th episode of my Road to Financial Freedom series, and for those that aren't familiar, this is where I document the growth of a small portfolio that I started about 3 months ago, which I'm trying to grow as quickly as possible using the strategies that I talk about on this channel, like covered call writing and leaps option buying. So I started the account with a $5,000 deposit, and in addition to that, I'm also depositing $200 every single week. So the goal is to simulate the portfolio of someone working to achieve financial freedom starting from scratch, and to see how quickly it can actually be done. So with that said, let's see how the portfolio is doing so far. So I'm just gonna jump straight into my spreadsheet here, and as far as my brokerage, I have stuck with Robinhood for the time being, so I'm still trying to make an official decision on whether or not I want to switch. So we can see that my current account value is sitting at $8,026, which represents a gain of $576. And in percentage terms, that's an 11.21% money weighted return, which represents a gain of 3.9% per month and about 58.7% per year. So I am still up overall, but if we scroll over to my chart here, we can see that it hasn't been the strongest last couple of weeks, but that's mostly just due to trends in the market overall. But of course, when we do see negative trends in the market, that'll often be exaggerated when you're working with smaller portfolios like this, because you tend to trade more volatile and uncertain stocks. But I still think the portfolio is in a great position, so let's get into some of the specifics, starting with my premiums from last month. So in February of 2021, I brought in $808 worth of premiums, which is about an 11% return from premiums alone, so I'm definitely very happy with that. So if you've been following my portfolio updates on Instagram, you know that I'm still selling covered calls on Zynga, I'm still selling covered calls on Switchback Energy, which actually just switched over to ChargePoint because of the recent merger, so the new ticker symbol there will be CHPT. And I also incorporated a poor man's covered call on Apple, which I'm going to talk about in a little bit more detail toward the end of this episode. So I was previously selling covered calls on Arcimoto, but I actually got out of that trade early, just like I did last month with Virgin Galactic, because the stock ended up rising so quickly. And I did discuss that decision in more detail in my last video, so you may want to check that out if you haven't seen it yet. So Zynga has been pretty stable, but the premiums do seem to be shrinking a bit, so if I do end up getting my shares called away, I'll have to evaluate whether or not I actually want to buy back into it. Then both Apple and ChargePoint have actually pulled back a little bit over the last couple of weeks, again mostly just due to market-wide trends, but ChargePoint has fallen in value by almost about 25%. And as I mentioned in the episode where I actually started trading ChargePoint, I did consider that as a possibility, and that's part of the reason why I chose this stock in the first place. Because this stock is pretty volatile, so the premiums are going to be pretty good, even if I have to sell them far out of the money as I'm doing now. So we can see the last call I sold, I collected a premium of $100, and that was for a call about 3 or 4 weeks out and probably about $12 out of the money. So if I can still collect premiums like that, even when the stock has dropped 25% since I bought it, I'm definitely pretty happy with that. Now moving on to my long-term holds, I haven't added any new ones since the last episode, so there's not really much to talk about there, but I'm currently up about $133 overall. Then when it comes to my leaps options, I'm still holding my AMD leaps, which has fallen in value a decent bit since I bought it. Again, mostly due to market-wide trends, but AMD has fallen a bit more than most. But nothing has changed with the company since the last episode, so I'm still very bullish on it, and I think it's just a matter of time before it shoots back up. And again, as I always say, that's why I like to buy leaps options, because if I had bought a shorter term option, I wouldn't have had as much time to wait it out as I'm able to do here. Also, just as a heads up, if you do want to download my spreadsheet template, you can find that in the description below. I kind of just made it up as I went, so it may not be the most user-friendly thing, but I do plan to make a video walking through how I use it in the near future. But if any of you are good with Excel and want to help out, definitely let me know, because we might be able to come up with something better that we can all use and follow along with. So now, as I mentioned earlier, I also want to go into a bit more detail on my Apple poor man's covered call, and also sort of talk about when I like to use the poor man's covered call in general. So in case you're not familiar, a poor man's covered call consists of first buying a high delta leaps call option, or in other words, a deep in the money longer dated option, and then selling a call against that option. compared to a normal covered call where you just buy 100 shares and then sell a call against those shares. So the goal of the poor man's covered call is basically to simulate a covered call trade but with a lot less capital. So for example, with the poor man's covered call that I set up on Apple, I bought a 75 Delta Leaps option that expires in June 2022, and to buy that option it cost me $3,590. Whereas if I were setting up a normal covered call on Apple, I would have had to buy 100 shares, which would have cost about $13,000 at the time. But in both of those cases, I could still sell the same calls to collect the same premiums, so for that reason, the return on investment on a poor man's covered call is much higher. But higher potential for returns pretty much always comes with higher risk, and in this case, the poor man's covered call is riskier than a normal covered call because your Leaps option has a time decay aspect to it. So that means that if the underlying stock drops below the strike price of your Leaps option and stays below the strike price at the time of expiration, then that Leaps option would expire worthless. So for example, with my Apple Leaps, if Apple ends up below $111.25 by June 2022, then I'll have lost that entire initial investment. But of course, I will have been collecting premiums all along the way by selling calls against that Leaps, so even if the option expires worthless, you could still end up profitable overall. And of course, the situation where a stock drops that much for that long is pretty unlikely to happen, but it's still something you have to think about whenever you do set up a poor man's covered call. So you definitely don't want your entire account to consist of poor man's covered calls, because if we ever hit a long-lasting market-wide crash, you'd pretty much be out of luck in that case. But it can be a useful strategy in smaller accounts, and honestly that's really the only case where I would use them. So if you can afford to sell normal covered calls, I think you should always just do that, because in my view, the main advantage of poor man's covered calls is not the accelerated returns, since that comes alongside a higher risk, but it's the fact that you can sell covered calls on stocks that you couldn't otherwise afford to sell covered calls on. For example, in this portfolio, I'm nowhere near being able to sell covered calls on Apple, but I can sell a poor man's covered call on it. So in order to be as safe as possible when setting up poor man's covered calls, you should always try to buy a Leaps with a delta of 0.8 or higher, and ideally you'd even want to go around 0.9 because those options have more intrinsic value, which means they're less subject to time decay. Plus, as you know if you've seen my Leaps options video, the delta value also indicates how quickly your option will move. So an option with a delta of 0.9 will move $90 for every $1 that the stock moves, meaning that it basically simulates owning 90 shares of the stock. And since in a covered call you own 100 shares, the closer you can be to simulating owning that 100 shares, the better. So in this case with my Apple Leaps, I actually didn't follow my own rule because this was a Delta 75 call at the time I bought it, but I would have much preferred to have bought a higher Delta Leaps. I just didn't have the capital available at the time and I really wanted to set it up on Apple, so I just went ahead with it anyways. Now the last thing I'll cover is just what I plan to do with this poor man's covered call on Apple depending on what happens with the stock. So right now my option is down about $700 from the price I bought it at, but I really don't ever plan to sell it at a loss, especially since it's on a solid company like Apple, so even though Apple has dipped a bit recently, it should definitely recover soon. So I just plan to keep repeatedly selling calls against it, and so far I've collected a little over $300 worth of premium from selling those calls. And Apple was at about $136 per share when I bought the Leaps, so I've just been selling calls around the $137 to $138 strike price to make sure that I still end up profitable if the stock rises. And if Apple does end up above my strike price at the time that the short option is about to expire, I'll just sell the Leaps and at the same time buy back the short call, and by doing that I'll end up profitable overall. But if Apple somehow doesn't rise to at least $137 by the time June of this year comes around, meaning that my Leaps option would then be within 1 year of expiration, I would think about buying back the Leaps and rolling it out to a later expiration date. So I do plan to make a more in-depth video on poor man's covered calls in the future, but for now that's my strategy. So now if you haven't seen my last video where I talk about why I generally don't like to roll my covered calls and what I do instead, be sure to check out that video in the bottom right corner of the screen. Thanks for watching, and I'll talk to you all in that next video.